Welcome to OJM Group's monthly webinar series. I want to take care of a few housekeeping items before actually jumping into the material. So before we move ahead with the presentation, here are just a couple slides with our disclaimers in them. Most important, in my opinion, would be that we are an SEC registered investment advisor with the principal place of business in the state of Ohio. In addition to those disclaimers, I also wanted to make available the offering for some of our materials for free to any of the listeners on today. There actually will be a code provided at the end of the presentation where you can go and download your free copy of the books that you see here on the screen. Most of them are tailored specifically for physicians. However, we recently just came out with this specific book here. It's titled Wealth Management Made Simple, 7 simple but not easy lessons on your investments and your wealth. And really what we're trying to accomplish here is really multiple focused here, but looking at just general information on market terminology, whether that's what a stock is, what a bond is. It explores behavioral finance concepts. It also discusses what an ideal advisory relationship should look like, from how much in fees should I be charged, things along those lines. So it's really trying to simplify investing in wealth management in general. So this again is newly released this year in 2017, and that book also is available for free to any listeners today. So without further ado, let's jump right into the topic of discussion for today's presentation. And really what we wanted to focus on, and it's a question that we've been fielding from our clients and prospective clients, revolving around markets being at all-time highs, and should you transition your portfolio to cash because of some economic collapse that's just around the corner. So we're really going to focus our time today on, let's just take a look at where we are from a current interest rate and inflation environment. If you do make that decision to go to cash, let's talk about what that looks like. And then really we're going to dive into our thoughts on timing the market and why we feel that isn't a prudent investment process. And thirdly, really focusing on having a process in place, really, instead of trying to time the markets, both on the upside and the downside. So looking at today's interest rate environment, as most of you probably know, interest rates are extremely low in today's environment, which as a person who owns debt, it's a good thing. If you look at the interest rate on your mortgages, probably less than 4%, certainly less than 5% for any folks that have refinanced in the last few years. So it's great as a person who owns debt, because your interest coverage, your interest payment is lower than it's probably ever been and will ever be. Take that a step farther, though, as an investor, on the other side of the coin, you're not really earning much in those traditional, safer cash-like instruments. I always tell clients, you go back to the 1980s, interest rates, you could buy a 10-year treasury bond for over 10%. Well, right now we're in the low twos still, and we have been there for years on end, it seems like. And even take that a step further with the safer instruments such as cash, think about your money markets, your checking savings accounts. You'd be hard pressed to find anything around a little over 1% at this point. So you're not being compensated to keep your money invested in cash, or having even whether that's just a significant portion of your portfolio or your entire retirement portfolio. Aside from that, there's also, you have cash earning low 1%, and I always look at the other side of the coin is what's the cost of goods and services as they've moved. Certainly those are getting more expensive as time moves on as well. Right now inflation's averaged just under 2%. So, money sitting idly currently earning, we'll call it 0.5%, 1%, you're actually losing your purchasing power because the cost of goods and services is going up at, 2% on average, depending on the industry, but right around 2%. So, pretty simple math there in terms, you simply aren't going to get the returns you need to achieve some long-term goals if you're only earning, a long-term expected rate of return of less than 2%. That's most likely not going to deliver on your goals, on your investment retirement goals. And I think also, when we look at clients that consider moving their portfolio to cash, I think it's a difficult behavioral issue as well, because let's say you decide to move your entire portfolio to cash, you must really be prepared to sit there and watch on the sidelines as the market reaches potential new highs. We've seen it. I mean, we continually have hit new all-time highs continually this year, and I'm going to touch that on in a couple slides. But it also points to the fact that when you're actually timing the market, you must be right not once but twice. And you may sell at a certain point, but when's the opportune moment to re-enter the market? We look back throughout the last crisis we had in 07 to 09. In hindsight, there was no white flag being waved back, when we reached the ultimate lows in March 2000. No one knew that was the low when we were living in real time during that moment. And we just think we're hard pressed to find anybody in the investment world that can consistently call tops and bottoms. So again, I'm going to hit down this theme, but I really think it's important that you have an investment process in place, and we're going to touch on those at the back end, what some of those are. Here's just another slide that just kind of shows you the global inflation is running at about 2%, but it certainly can be greater or less than that depending on the area of the globe. So here's a slide I wanted to show people, folks listening today, just to give you a sense of how markets perform after financial crises. I think a lot of people, when they say they want to go to cash, whether it's at market peaks or when the market's getting towards its low, I just wanted to show, hey, typically stock markets do well after recoveries, after a financial crisis, but really just shows you that I think fear and uncertainty might lead investors to sell their investments during tough times or in good times. I think it's these emotional implications that can be really detrimental to a portfolio's value. By selling during downward pricing pressure, I think investors must realize short-term losses. Not to say that we're coming into a financial crisis, but I just wanted to kind of put this out there. I think also this is compounded as investors wait and hesitate to get back into the market. Let's say you go to all cash and you hesitate, psychologically to get back in, you possibly might miss some or even all of these returns that you see here on the screen. So I think the lesson for me is that patience and that strategy and process pay off over time. This next slide really kind of graphically shows you the importance of staying investors. Again, I think investors who attempt to time the market really run the risk of missing periods of really exceptional returns. And that can really affect the money or the dollar value of a portfolio. So let's just look at this example where we assume the value of $100,000 back to basically when we hit the all-time high, the previous all-time highs of 2007 before the quote-unquote financial crisis. So the value dropped to $54,000 by February 2009, following that severe market decline. If an investor, so let's just kind of assume three scenarios from that point in 2009. If an investor remained invested in the stock market over the next 82 months, so basically until this year, the value would be just under $200,000 at $195,719. Let's just say the same investor exited the market at the bottom to invest in cash for a year. And then they said, okay, I think we're the bottom's in, I'm going to reinvest. So just that one year of delaying, moving to cash, delaying that 1 year and then re-entering the market. That person would actually have almost $70,000 less in any value at 127. So it'd be 195,000 if you stayed invested the whole time, 127 if you didn't. And then that last one is an all cash investment in the market at the bottom at 54,580. Really, obviously, once you're in cash, you're not getting any growth. You might get some cash dividend or some small interest payment, which we just talked to, probably wasn't very much, but really not increasing the value of your underlying portfolio. So I think that clearly here, the continuous stock market investment recovered its initial value over the next 3 years and provided a higher ending value than, the wait for a year, reinvest, or just stay in cash this entire time. So I think you'd be well advised if you would have stuck to this long-term, kind of stick to your process again. And, lastly, I just wanted to show, I think it's important just to look at, there's prediction and calls for market tops always exist, and there's always a reason right around the corner, or an excuse, I would say, for why you should liquidate your portfolio, right? I think a lot of times clients sometimes think that they know something is going to happen, and that can really be detrimental because it leads to overconfidence, which can lead to over trading, and in turn lead to underperformance, as we just saw. So, on the chart here on the left, again, if we see some smaller or some corrections of greater than 5% since March 2009, even though we know that the market's done what it's done since then, you can see there's a whole host of reasons that pop up into the market, whether it's Fed taper tantrums or issues in China's lending space back in 2010. You could talk about falling oil and the falling dollar back in 14-15, Greece default concerns. It's almost comical going back, Ebola. It's almost comical going back and looking at these, but in real time, those were serious concerns. And when you see those corrections of 5 to 10%, and when you're dealing with people's actual hard-earned dollars, it can be very emotional in those moments. And then the chart to the right really shows you some of those same headlines, but charted over time, just showing that the market continues to persist as long as revenues and earnings are driving that growth. They consist over time. And you can see here too, and I think one of that big pushbacks is, we're at all-time highs, the market can't do anything but go down. And I say, well, let's take a look at, if you go back to the 1980s, for example, the S&P has actually experienced 737 new all-time highs. Of the 737, only 3 of them were major tops. So really the data suggests that new highs are often the best time to buy, really, not sell, you could argue. As long as, again, you have that process, that balanced approach that doesn't necessarily give you more risk or provide you with more risk than you're comfortable putting your head on the pillow at night with, you certainly don't want to build a portfolio that's going to have you react negatively from an emotional standpoint. So it's important that you develop that process and have everything in place before any of these things happen. So just to kind of recap here, I think it's important, if you look at, hey, markets are at all-time highs, why shouldn't I go to all cash right now? Again, it's, I may change my tune in 3, 4, 5 years from now if interest rates pick up and you're actually able to earn some more or have some additional return on cash. I don't think we're necessarily going to be there, but if that happened, maybe you change your stance a little bit. But I think it's important you diversify your portfolio across multiple asset classes. We're always preaching, for us here as U.S. investors, it's easy to ignore what's going on globally, whether that's in Europe or not in some of these emerging market economies. But year to date, actually, a lot of those economies are up over 20. Emerging markets up over 30% even. So, and those have been areas that have been really hard hit the last couple of years during this U.S. recovery. So if you abandon those areas, those are actually the ones performing the best this year. So for us, it's about diversifying across multiple asset classes at all times. You're always, we're always going to have stocks, bonds, et cetera, inside of our client portfolios. And another strategy potentially look at, if you're concerned with, I really just don't feel comfortable putting my money in at market tops, well, maybe you consider a dollar cost averaging strategy where, over a series of, define it, whether it's every other week I'm going in on Wednesday and placing X dollar amount of trades and just working through that and say, hey, I'm going to do this over the next 4 months, and you do that. Just so you're not putting in all that new money or potential new dollars in at a certain day, maybe the day's up 3% and you're putting in an even higher market. So you want to avoid some of those short-term fluctuations, both up and down, by spreading that out over a series of months. That's also something that we would recommend. And then really, I think lastly, the last 2 points here, obviously this is what we live and breathe. So I think it's always prudent to hire a professional, because we've been through this. We understand that the market, there's ebbs and flows, and money is very emotional to you as the investor. It's not so much for us. Again, we're more process oriented. And then really just focus on the things you can control, which at the end of the day is working hard and putting savings towards your retirement and trying to reach those retirement goals, whatever those may be. Because at the end of the day, whether you look at today, whether it's potential implications in terms of the stock market, whether it's some cyber warfare with Russia or nuclear war with North Korea, those certainly would have implications on the market. But those are things that are outside of all of our controls. We can't plan for that. We can't foresee those things. So it's important to just really focus on the things that you can actually control. Today, I covered just one specific topic in the area of wealth management and investing. But here at OJM Group, we have an expertise in a number of planning areas. We have a multidisciplinary team that includes attorneys, CPAs, CFPs, MBAs, investment and insurance professionals. Please look out for some of our additional videos where you will hear from other members of our team who have expertise in these different planning areas. OJM Group does specialize working with physicians and business owners, and certainly individual clients as well. Our 3 divisions where clients come to us are investment management, consulting, and insurance benefits. We've been helping clients for over 20 years. In fact, we've actually worked with over 1,000 clients throughout the country across 48 states. We do, in terms of planning, we can do planning on both the corporate or the personal side. So as I mentioned at the beginning of the presentation, those listeners today are able to receive a free copy of one of our books. You can go directly to our bookstore website, which is www.ojmbookstore.com. And on that screen, during that screen, when you go to the checkout, you'll use the code OJMWEB to get that free copy of one of the materials we showed at the beginning of the presentation. In addition to the free book, we also offer a complimentary consultation where we look to answer any questions you may have, and also to see if our firm potentially is a good fit for your situation. Enjoy the copies of your books. Also feel free to reach out to myself, presenter Adam Braunscheidel, at the number or the email listed. Enjoy the books, and look forward to having the opportunity to speak with you. Thanks for watching.